Hi, in this video, we will start the topic of combination and consolidation between two companies. And this topic will take several chapters with us. First of all, when a parent company is acquiring a subsidiary company, they might give cash or they might give shares to the subsidiary company for the sake of taking either 100% of ownership or significant percentage of ownership, like any percentage above 50%. And we usually face three issues. The first thing is the journal entries that we should make it when we make the acquisition. And then the worksheet that we should make it to disclose the balance sheet of the parent and the subsidiary, and how we make combination between the two accounts, and finally, how to make the financial statements, whether a balance sheet or income statement or cash flow between those two companies. In this video, we will talk about journal entries only for this topic. So with this in mind, let's start talking about the journal entries that we need to address. First, when we create a business entity, what does it mean? This means a parent company, we will save a separate amount of cash or inventory or assets to create a subsidiary company from scratch. Second, we will talk about journal entry for a parent company that will acquire a subsidiary company that is already existent in the stock market, and whether they give cash to subsidiary or they give shares or both of them. When a parent company is creating a subsidiary company from scratch, there is no difference here between the book value and the fair market value because the company is creating that subsidiary. But if the parent company is creating a subsidiary company that already exists in the market, then we might face three issues. Either the book value is equal to the fair market value of the subsidiary company, which is rarely happens, or the fair market value is higher than the book value, or the fair market value is lower than the book value. If the fair market value of the subsidiary company is higher than the book value, we create a new account, we call it Goodwill. The Goodwill is created by the parent company, where it puts the extra amount they pay to subsidiary to the subsidiary company. If the fair market value is lower than the book value, we call it bargain purchase, and we'll also make a journal entry for that. The bargain purchase, you could say it's the revenue on acquisition, but we cannot call it revenue. We call it bargain purchase, as if the parent company made a bargain to buy the subsidiary company. The differential comes by having extra payment above the fair market value to the subsidiary company. So if the fair market value is higher than the book value, we make Goodwill. But if the company paid a higher amount than the fair market value, we call it differential. And we will go through the journal entries for each one of those four categories. So let us talk about the journal entries of creating a business entity. And here we have Allen Company creates subsidiary company and transfer assets to that company, which is called Plain, for all the 100,000 shares of Plain Company for $2 of their common stock. And here is the items that the parent company is allocating: cash, inventory, land, building, equipment. And the book value for the cash is the same. The book value for the inventory is equal to the fair market value. The book value for the land is equal to the fair market value, but the building and the equipment, you can see there is difference here. Where the difference comes between the cost and the book value, it comes from the depreciation. Depreciation for the building and depreciation for the equipment. Remember, those items have been transferred from the parent company to the new subsidiary company. So how Alan is going to create this company? Alan will say debit in investment in plain company, debit accumulated depreciation, debit accumulated depreciation for the equipment, and then credit all the assets. Why Alan is doing that journal? To remove those assets along with their depreciation to the subsidiary company. How about plain? How plain is going to record it? Because plain is going to receive those assets, will record all the assets as debit, accumulated depreciation for both assets as credit, and then credit common stock for $2. And if there is any extra amount above the par value of the common stock, they will go on additional paid-in capital. So here we can see a parent company is creating a subsidiary from zero. But in reality, the parent company might invest in another existing company by giving them assets or shares. How can we do that? So here is Albert Company acquiring all. When I say all, it means acquiring 100% of ownership from Zanfor Company for $400,000 when the fair market value of the net identifiable asset of Zanfor Company, 380. The fair market value of Zanfor Company is equal to the book value. However, the land for Zanfor Company, which is the subsidiary, has a fair market value higher than the book value by 100,000. So to make it easy, Zanfor Company has assets of book value 400, which is mentioned here. The liability 120, which is not included here, but it's given in the example. And the net assets 280. And what do you mean by net assets? You call it the ownership. But the land has a higher fair market value by 100. So here we can see the fair market value of the assets higher than the book value by 100. And the net identifiable assets, 380. Okay, so now how much the parent company is going to pay to the subsidiary company for getting a full ownership? They will pay 400,000. So since we have higher than the net identifiable assets, the difference we put it under Goodwill. So here we are paying more than the total amount of ownership by 20,000. So we record this one as Goodwill. Remember, the Goodwill is not a revenue account. It's an asset account. And it will be recorded under intangible assets, and it will be adjusted every year if there is any impairment or reduction happen in the Goodwill. So please remember this key point, that Goodwill, it's not revenue. And bargain purchase also is not revenue. It's, we call it intangible assets. So here the Goodwill is 20,000. The net identifiable access is 100. The book value is 280. And we debit investment in Zanfor Company, debit Goodwill, and credit cash. Who's going to make this journal? The parent company. So investment in Zanfor Company will show in the parent company as one of their assets. The Goodwill, it's one of their assets in the parent company, and we credit cash. Okay. How about if we have controlling interest? What do we mean by controlling interest? We own significant ownership above 50%, but lower than 100%. Anything between like 51 and 100, here we call it controlling interest. What do we mean by controlling interest? Controlling the management of the company, controlling the board of directors, controlling the income of the company. We have significant control over the company. And here the parent company will own 75%. If it's above 50%, it goes under control. So what do we call the 25%? We call it non-controlling interest. And when we make consolidation, we will show the non-controlling interest into the financial statements of the parent company. So here we owned 75% by paying 300,000. And the non-controlling interest is 100,000. And here we see the fair value 300, the fair value of the non-controlling interest 100, the total 400, and then the fair market value of the net identifiable asset of the subsidiary 380, and the goodwill 20,000. So how we make the journal entry here? We debit investment in Zanfor company by 380, debit goodwill by 20, and this can tell you that the debit side doesn't change, whether we own 100% or less than 100%. But in the credit side, we put cash and non-controlling interest, and this will show on the parent company accounts. So what are the items included in the acquirer's cost? It means any expense we pay it in addition to the cash or the shares that we give it to the subsidiary company. Here, if we give them shares to the subsidiary company, we check the fair market value of the common stock of the acquiring company on that day of acquisition. If we cannot get the fair market value of the items or the shares given, we check the fair market value of the items received. So number one, the fair market value of the shares we give to the subsidiary. Number two, what will happen if we pay legal fees or accounting fees or any other fees on the date of the acquisition? In the prior years, we used to count all these fees as part of the assets and we capitalized them. But the FASB, they came up with the latest standard that consider all of the fees we pay to the acquisition process, we consider it as an expense, and it goes into the income statement. So whether legal fees or accounting fees or any fees, we consider it as expense, not an asset. What about any fees we paid for the acquisition of the stock? Then we put it as additional paid in capital. The third thing, what will happen if a condition happen in the future? Like maybe reductions in the prices of the shares of the acquiring company. Here we create what we call it contingent consideration. What do you mean by contingent consideration? Something happened in the price of the shares during the following year of the acquisition. We create a liability here and we call it contingent consideration. And we will go through these items in the following examples. So the first item is the acquirer's cost. What are the items that we need to check their fair market value? Cash. And the cash has no issues about fair market value because usually the fair market value of the cash is equal to the book value. It doesn't change. But we need to check the common stock, preferred stock, note receivable or bonds payable that we give it to the subsidiary, any used equipment like trucks, and we consider all these fair market value of the assets. So here in this diagram, we see the parent company is giving shares to the subsidiary, and here we check the fair market value of the shares that the parent company is giving to the subsidiary. If we cannot get the fair market value, then we check the fair market value of the subsidiary to the parent company. So P stands for the parent company, which is the acquirer company. S stands for the subsidiary company, which is the acquired company. And the general rule, as I said, we check the fair market value of the shares we give to the subsidiary. The exception, we check the fair market value of the shares received from the subsidiary. And by the way, it's easy to get the fair market value by asking the broker or the stock market regulator to get the fair market value of the shares on that day of the acquisition. So here the parent company acquired 100%, and I hope you remember now that 100% it's full ownership. Anything between 51% and lower than 100, we call it controlling interest. And here we give cash to the subsidiary, 2,500,000, and we give them shares, 20,000 shares. The par value of the share is $1. It means the common stock will be equal to $20,000, and the fair market value for each share is 50. So the $49, which is the difference between the fair market value and the $1 par value, it goes to additional paid-in capital. So here are the items. We have cash, 2,500,000, common stock of 1 million. And how do we get this 1 million? We multiply $50 times 20,000 shares. The total will be 3,500,000. And we debit investment in SAKE, and this would be in the asset side of Pete company. We credit cash, we credit common stock by the par value, and the difference between the par value and the fair market value will go to additional paid-in capital. Now, what will happen if we made some expenses like legal expense, purchase investigating fees, finder fees, travel costs, professional contingent? All of them, they used to be capitalized. It means assets, but according to the standard of 805, it became as expenses. And who will record them as expenses? The parent company, because the parent company is paying those fees and they will go under expenses. And if we pay anything related to the issuing stock, we'll go to additional paid-in capital. What are the costs that we pay to the issuing stock? Either legal fees or accounting fees or filing fees at the Security and Exchange Commission. All of them will go under additional paid-in capital. So here we have Pete paid all these expenses, legal fees, accounting fees, travel expenses. The first three items are for the acquisition transaction. The last three items for stock issuance. And here we put the last three items as additional paid-in capital, the first three items as expenses. How the company paid 144,000, they split them into two groups. 117 had been paid and charged to deferred charges. And the remaining amount has not been paid, still accrued. So how can we journalize it? We split them like this. The acquisition expense that will go into their income statement, 90,000. Anything related to the issuance of a stock will go to additional paid capital, 54. So we debit acquisition expense by 90,000, additional paid-in capital, and this amount will reduce the additional paid-in capital because additional paid-in capital is shareholder equity account. When we take something out of it for expenses, it will be debit. Excuse me. And then we credit deferred charges by 117, accrued liability 27. When we pay those items, we debit those two accounts and then we credit cash. But for the time being, we need to worry about those two items, acquisition expense, additional paid-in capital. What will happen if we made a commitment to the subsidiary that if something happened to the shares in the coming year after acquisition, we will make a special payment to the shareholders of the subsidiary company. Here we create an account, we call it contingent consideration. So contingent consideration, it's payment that might happen in the future if some changes happened in the stock market. And here, for example, we agree to issue additional shares in 6 months if the share given, they lose value in the stock market. We record it at the fair value of the acquisition. And this is, as I said, it's commitment from the parent company to the subsidiary company. And we mark to market each subsequent period until the contingent event is resolved. So we check if there is any changes happen to the market in the coming years until we resolve this contingent consideration. Now, let us talk about combination effected through the acquisition of net assets. What do we mean by that? I assume parent company acquires 100% of the assets and all the liabilities of a subsidiary company called Sharp, and they issued 10,000 shares of $10 par value to the subsidiary. The shares issued have a total market value of 610, and they paid expenses of 40,000, and this will go under expenses, not capitalized. And they paid $25 for the stock issuance, and this will go to additional paid in capital. And here are the assets and the liabilities of the subsidiary company. As you can tell, the cash has no difference between the fair value and the book value. The inventory has $10,000 extra in the fair value. The land has $30,000 in the fair value. The building has 50,000 less because it's related to the depreciation. And there is intangible assets, which is the patent. Patent, it's an intangible asset. And then the liability has fair market value of 110, and the net identifiable asset 510. So based on the net identifiable asset of the fair value, 510. But if I go back here, the company paid 610. So the difference between 610 and the 510 here, this is 100,000 goodwill. So here we see that there is goodwill of 100. From where it comes, the difference between 610 and 510. But what about the difference between 510, which is the fair value of net identifiable asset, and the book value, 300? This one, it's excess of the fair market value. If I add the excess of 210 plus goodwill 100, this we call it differential. So the differential of 310 is the total of goodwill and the excess of fair market value. So let us make the journal entry here. Of course, the 40,000 will go under expenses. So we debit acquisition expense and we credit cash, and this is made by the parent company. And here is just explanation. And now we need to know how can we make the recording. So on the date of combination, point records the acquisition. So here we debit cash, inventory, land, building, patent, and the goodwill here is going to be the new asset account that will be created. We credit the fair market value of the current liability, the common stock additional, and this item, it will be taken from the additional fair market value. So we debit all the assets, the liability, and the common stock, and remember the parent company will make this journal. So please remember, in the combination, we have to identify what the parent company is going to do in their book and what the subsidiary company is going to do in their book. Please make sure to separate between those two sets of accounts, because if you don't separate them, when we come to do the worksheet and the financial statements, they will not become accurate. The entry records all of the assets, liability, and intangible assets on points book at fair market value, and this is what you can see here. The 100,000 will be recorded as a goodwill, and then the stock issuance will be in a temporary account until we deduct it from the additional paid in capital. And the difference here of 600, as I said, it will be the differential, which will have the difference between the fair market value and the book value. Points record the 610 of stock issued at the fair value minus the stock issuance, which is 585. And the difference will go under deferred stock issue costs. On the date of the combination, Sharp So the coming journal entry will be made by the subsidiary company, not the journal entry of the parent company. So here, debit investment in point stock, we debit current liability, accumulated depreciation, and we credit all these assets. So Sharp records the following entry to recognize the receipt of the shares of Point and transfer all the assets to the parent company. So again, when you make notes, when you study, try to make one page for the parent company journal entries, another one for the subsidiary, to make sure you separate between the two journals. In the assignment questions, when you do it, please watch out. What is the question? Is it related to the parent company journal or the subsidiary company journal entry? The distribution of Point shares to Sharp shareholders and the liquidation of Sharp. So here, when the company is giving the shares to the subsidiary shareholders, it's recorded in this way. We debit common stock, we debit additional paid-in capital, retained earnings, gain on the sale, debit investment. And here the company, because the subsidiary will be liquidated, if the parent company is buying 100%, as if the subsidiary shareholders will not existed as subsidiary shareholder, but they will become part of the parent shareholders. So for the liquidation, we make this journal entry. What will happen? And now we have 100,000 of goodwill that has been recorded by the parent company. And the goodwill comes from the increase in the fair market value above the book value of the subsidiary. But what will happen to the fair market value of the subsidiary assets over the coming years? They might go lower. If they become lower, we have to make an impairment journal. Excuse me. The goodwill here must be tested for impairment. What do we mean by impairment? Reduction in the asset account at least once a year, and we make it every year. We check the fair market value of the assets and we reflect. When goodwill arises in business combination, it must be assigned to individual reporting units, which is usually the parent units. To test for impairment, the fair value of the reporting units is compared with the carrying amount. What do I mean by carrying amount? I mean the current amount of the impairment after any calculation of impairment in the goodwill. A goodwill impairment is measured as the amount by which the carrying value exceeds the fair market value. So if the current value is 80,000, but the fair value of the goodwill before it was 100. So we make impairment by 20,000. Now, let us shift the gear and talk about bargain purchase. Because goodwill, it comes when the fair market value or what we pay to the company is higher than the net identifiable assets. But what will happen if the subsidiary company is in bad need for money and liquidation? Maybe the parent company will take advantage of that and pay less. In this case, the parent company made a bargain or made a gain, but we cannot put the gain as part of the income for the parent company. We put it in a separate one. We call it bargain purchase. When a bargain purchase occurs, the acquirer, which is the parent company, must take steps to ensure that all acquisition date valuations are appropriate. And then we start to do the calculation. Here if we use the data from the previous example, if you remember, we say we paid 610, but now we paid 500. So here Point Company is able to acquire Sharp for 500 cash, even though the fair market value of the net identifiable assets was 510. So we paid less than the fair market value. So here we recognize 10,000 gain, but we record it here as gain on bargain purchase of Sharp Company. It's not part of the normal revenue account, but we put it in a separate account, gain on bargain purchase. So here we debit cash, inventory, land, building, patent, all of them at their fair market value. We debit cash, current liability, and gain on bargain purchase. Remember here in this example, we didn't talk about common stock because we assumed we paid the full amount in cash. So now let us make up a wrap up. We say goodwill versus bargain purchase. What will happen if the fair market value is higher than the fair market value of the net identifiable asset? We create goodwill. What will happen if it's the opposite? We make bargain purchase. What will happen if they are equal? Well, there is no bargain purchase or goodwill. So please remember this one. The goodwill is calculated as the residual amount. What do you mean by residual amount? The difference between what we pay and the net identifiable assets at their fair market value. First, we estimate the fair market value of the net identifiable assets, include tangible and intangible assets. We get all the assets. Second, we subtract the total fair market value of all net identifiable assets from the fair market value given by the owner, whether we give cash or common stock, and then we see the fair market value of what we receive. The difference between them is the goodwill. The residual is deemed to be a goodwill, and here is the equation. So this is a wrap-up example, by the way. So you will see here in this slide a goodwill. In the next one, we will see bargain purchase. So here we assume big company pays $400,000 for little company, and the estimated fair market value of the assets is as follows. So here we have the total assets 400, the liability 200. So the net identifiable assets 200, which is the difference between 400 and 200. And the goodwill will be 200 because we paid 400 cash. So 400 minus the difference between these two accounts is goodwill. So we debit here all the assets, debit the goodwill, credit the cash and the liability. And then the goodwill, as I said, must be capitalized as an asset. And if there is any impairment, we have to make it. Cannot amortize to earnings. So we cannot take the goodwill and put it as part of the earning over the coming years. And we make assessment annually to see if there is any reduction in the goodwill. If impaired, it must be write down and charged to earning. What will happen if we have the opposite? The bargain purchase element is still record the assets and the liabilities, but the difference will go under bargain purchase. And here is an example. The net assets, 400,000, the liability, 200,000. So the difference between them, 200,000. But here the company paid 150. So we have gain on bargain purchase for 50,000. So here we debit accounts receivable, inventory, market, equipment, property, plant, and equipment. And then we credit here gain on bargain purchase, cash, and liability. So this is in brief all the journal entries that we need to do, whether when we start a subsidiary from scratch or we acquire all the ownership of a subsidiary company or controlling ownership of a subsidiary company. We might face goodwill or bargain purchase. It depends on the situation. I hope you find this video useful, and I will discuss the worksheet and the financial statements in another video. Thank you. Bye-bye.